Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, February 22nd, 5:46 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend with a short-term caution since we've got two closes below the 21-day moving average on all five of the major indexes. Leaders holding up okay. Leadership got a little bit of a boost after hours with NVDA reporting well-received earnings report up about 8% at this point. As you can see over here on the trend gauge, we're showing bullish for leaders. Short term, we put the caution signal up yesterday, two closes below, officially moves the arrow to bearish slash downtrend for the short term moving average. Medium term, we're on green with the exception, all four of the five above their 50-day moving average, and it's sloping higher with the exception of the Dow, which is below and is sloping lower. Long term, we're at neutral. We've got all five indexes above it, but the slopes of the lines vary. We need to see some more strength, and for that strength, it'll have to be persistent, and that'll drag the slopes of those lines higher. And historically speaking, a upward sloping moving average provides better support than a flat or downtrending moving average. So what happened today? Given it the cautionary yellow ink today, index is mixed. Probably, if I had to say, it was a bit closer to good than bad, as the S&P 500 undercut and reclaimed its 50-day moving average. Looked like a shakeout late in the day when we finally gave way below the 50 and then quickly slingshotted back above it. Here are the final numbers. G6, this is our 6 ETF growth composite. Had a great meeting with a client last night. I'll give you the six ETFs in case you don't have them. We've discussed them before, but not lately. The six ETFs are IWO, that is the Russell 2000 growth component, FFTY, that is the IBD 50 index, QQQJ, that is the NASDAQ 100 mid cap version, PDP, that's a Dorsey Wright Momentum ETF. MDYG, that's the mid cap, S&P 400 mid cap growth component, and ARKK, that's the world renowned Kathy Woods flagship ETF, ARKK. So we add those up every day, divide by 6. That's how we get the G6. We track the trend on those to see how to get a risk on or risk off signal for growth stocks. S&P 500 on the day down 0.16%, NASDAQ 100 positive 0.07%, Dow down 0.25%, mid caps positive 0.13%. Russell 2000 small caps up 0.34%. Global diversified 60/40 down 0.09%. This was boosted by bonds. Bond prices up across the board today, meaning bond yields were lower. In-house GROTECTION down 0.46%. A little bit of a whipsaw in-house, but we'll take a whipsaw. It's better than a persistent move lower. We can always buy back if we have the option. And we didn't close out the positions. We just reduced them before they bounced back and showed a little bit of strength into the close, along with the indexes. We'll go through that when we hit the tail of the tape and the chart. So let's dive right into it. Why do we do what we do here at Revere? It's not that chart. It's this chart. Last 13 bear markets. When do these occur? They occur under the 200-day moving average. Risk management is our number one job here. We know that all of these occur under the 200-day moving average. The typical move from the high to the break of the 200 is about 12%. This last bear market, it was about 9.2%. And then under there, what we're trying to do is gauge how painful the market can get by looking at what leadership stocks are holding up, what sectors are acting well, is growth or value holding up, is the Dow leading? That's a bad sign. That normally means the market is switching to a more defensive posture. And what we try to do is minimize the difference between that 12% and these losses that are shown here. The most severe over 30%, Losses the average minus 44.5%, takes 80% to get back to even. This last January to October, 27.5% drawdown. We need 38% to get back to even. The market's trying as it's crawled back above the 200-day moving average, crawled back above the 50-day, crawled back above the 21-day for about 4 or 5 weeks, but gave it up this week. Today we bounced at the 50-day, which is where we needed to. Let's take a look at a 1-minute chart here. This is the candle right here. The market was holding. 39.79 was the S&P 500 50-day moving average. We tested it several times, finally gave way. Looks like we got a lot of stops triggered there. Slingshotted right back up and higher into the close. Stay of execution for now. After hours, the S&P up about 0.2% on the back of NVIDIA's earnings report. We'll go right to NVIDIA here so that I don't forget. NVIDIA up. It's trading after hours at 225. We bought a 1% position at 223 and change after hours. So the high before this last 4 or 5 day pullback was 230.49. So we'll see if we can clear that tomorrow, or if this is just a gap that gets sold off, which we've seen a lot of lately since that employment report came out. And then the following the strong CPI and PPI data, which called into question the Fed pausing interest rates and was the spark for this latest pullback. But for now, the pullback has stopped at the 50-day moving average, just the way we wanted it to. We're hanging out around this 4,000 level, 1.3% above the 200-day moving average, which is nearly flattened, but still less than $1 a day going down. We want to see that flatten out and rise. I'd like to not even see it tested, but maybe we will have to test it, undercut it, and get back above it. A lot of cross currents on the macro side. A lot of wall of worry being climbed right here, but you can see S&P has gone over the last 2 weeks from overbought down now officially on oversold with the black line. That's the stochastic. The blue line is the moving average of the stochastic. We'll see what it takes to turn this back up tomorrow or the next couple days or into next week. If it happens, we can stay under there for a few weeks at a time, just like you can stay overbought for a few weeks at a time. But for now, we held where we needed to hold at the 50-day moving average. Let's move on to the NASDAQ 100, which is up 0.6% after hours, as it's heavily tech weighted, has a bunch of semiconductors in there, and NVIDIA is certainly sparking that move. We didn't touch the 200 yet. The 50 is still below the 200 because of the extreme amount of time that the NASDAQ 100 lagged the S&P. During this downtrend, while all those big FANG stocks were being sold off from August clear through till the end of the year, and then bought back after the new year. Looks like that's what was responsible. That was the outperformance in January, kind of going sideways since then. Not quite oversold yet. 2 closes below the 21. We'll see where we need to get tomorrow, if there's enough juice and if enough staying power for the semiconductors to take the NASDAQ 100 back higher. Let's go next to the Dow Jones Industrial Average. Relative to the moving averages, the weakest of the indexes. You can see its second close below the 21 and the 50-day moving average, approaching oversold. Well, it's in oversold. The moving average not into oversold yet. Lots of support over here around this 32,500 area, and between 32.5 and 33.5. Big area of support here. Let's go to mid caps, which has been the strongest index, but 2 closes below the 21, and it's rolled over, not quite to oversold yet. Still holding up relatively well versus the S&P, which bounced at the 50 today. You can see mid caps still 2.2% above the 50-day moving average. Small caps, 2 closes below the 21, still 2.2% above the 50-day and 4% above the 200-day moving average. And that 200-day moving average actually ticked up by a penny today. So maybe it's all not fire and sackcloth and ashes in the markets. Maybe we can put in a bottom here and bounce. If nothing else, we're at the bottom of the range, and it's much less risky buying the bottom of the range than it is buying the top of the range. We may be range bound. We were looking at some historical precedents this week in house. Let's go back to a really crappy time in the market, 2015. This was brutal, uh, just brutal chop. We were holding above the 200-day, but it was just up, down all summer. Uh, from February all the way through the summer to August, we had a big breakdown here. This was, I believe, the Greek uh, bankrupt bankruptcy bailout issue. We broke the 200. This would have been a time where we got defensive. We came back above it and then broke below it again. They never make it easy, uh, but it's just an example of the choppy. And what do you do during choppy periods? You try to minimize the number of trades, try to keep them smaller, try to buy at the bottom of the range, not the top of the range. Make sure it's extreme strength if you're buying something. Breakouts were working until February 3rd when that employment report came out, and that put the screws to growth stocks. They've been underperforming ever since. So let's move on to the dollar today. The dollar didn't give stocks any help as it was up all day, making a higher high, still below the 200-day moving average. It is in overbought, but hasn't rolled over yet. The VIX was down on the day, closes above this 50-day moving average now. You can see the slopes of the lines starting to turn up. How about bonds? I said they were all up today, and they were. Here's BND, the broad index, bouncing. You can see how oversold bonds are. This is good. We get the price going higher off of oversold. That means yields are coming down. That should help stocks. That's been the inverse correlation lately. So there's BND. Here's corporates, LQD. Also oversold. We're up on the day. Here's junk bonds up on the day, and TLT, the 30-year, up on the day. How about the yields? This means the yields were down, right? Here's the 10-year yield. This is showing lower by 0.8% inside day versus yesterday, and the 30-year TYX inside day versus yesterday down 1.2%. The Fed minutes came out at 2 o'clock today. Gold continued to get hit harder after that. You can see how oversold it is, but just not showing any penchant to bounce. There's GLD, GDX broke below the 200-day moving average today, which is sloping lower, and SLV very oversold. Also didn't make a lower low. Note that gold did, but silver did not. So maybe time for silver to outperform gold. Let's check Bitcoin very quickly, down 2.82% on the day. So showing a little bit of risk off there. So those are the major well, let's show two more. Let's show the S&P 500. Equal weight down 0.12%, also bouncing at the 50-day moving average, and then QQEW equal weight NASDAQ 100 positive on the day. So they were both pretty much in line with their market cap weighted counterparts. Let's go to the tail of the tape now. Short-term caution. You can pause it and read all the numbers. The Fed minutes came out at 2 o'clock, and a few wanted 50 basis points at the last meeting. Let's go to a 5-minute chart on the S&P, and you can see how squirrely things got after the S&P minutes came out. So intraday, we made a low kind of early, rallied to the highs of the day. We're up about 0.4%. And then just chopping up and down afterwards, making a lower low before that undercut and reclaim of the 50-day moving average and rally into the close. So that supposed news about a few more Fed heads wanted 50 basis points. It actually looks like they would have been correct based on the strong economic data that has come out since then. So day count going from down 3 to down 3 with a consolidation day, 4 days below the 8 EMA, 2 days below the 21 EMA, 32 days since the follow through day. I'm negative under the 50-day moving average, neutral above it. So we undercut and reclaim. So we're basically neutral here for now. We'll show some of these charts, what we did in house today. So on the weakness, our stops were hit on a third of our position in Airbnb and ON. Let's take a look at those charts. Here's Airbnb. It actually undercut and then reclaimed the 8 by the end of the day. This is what we wanted to see it do. Volume is dried up over the last 2 days to below average. This needs to get a move on if it's going to stay in sync with what some of the gaps higher have been doing. But again, this did gap higher, and then on 216, that's really when the market started coming back to the downside. So it gapped up at a tough time. ON also uh, first close below the 21. We trimmed that. Need to see this come back. It is semiconductors are getting a boost after hours, so we'll see if this participates on that tomorrow. What else? Oh yeah, SARK. So when we were breaking down this morning, we added more to SARK. It then reversed at the 21-day moving average. And when we got back to even on that position, we sold 3/4 of it. And then after hours, let's see, we bought NVDA at, as I said, 223 and change. Let's see what other charts we want to take a look at today. There were some that, well, let's finish up the tail of the tape here. So we adjusted our portfolio from 0.93 to 0.88, so down a little bit. The bottom line on the day index is mixed. S&P 500 undercut and reclaim the 50-day moving average. Let's see if NVIDIA can spark the indexes tomorrow. Let's look at a couple more charts today. So a gap up that worked. Palo Alto, PANW, nice gap up, big numbers, up 413%, nice fundamentals. They're profitable, not an outrageous PE. This looks good, so we're going to monitor this one going forward. Follows up on FTNT, which had a positive reaction to earnings 2 weeks ago. And actually made a higher high afterwards before the market started causing it some headwinds. Wing reported earnings, big gap up, but a reversal and close near the low. Still finished up 7.7%, but it was up as high as 194 after hours. WSC, one that had been acting well. That's not a good candle. 144% above average volume. Decent numbers, but the market initially gapped on it and then reversed lower, closed below the 21. Sometimes this puts in the lows, sometimes it's the beginning of a sell-off. So we'll monitor that one going forward. And that's going to wrap it. As always, love to hear from you. Email is don@revereasset.com. If you're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make in the market, it's how much of that you can keep. It's been a rough last week in the markets. Really a rough last almost 3 weeks, 2.5 weeks since that strong employment report undid Jerome Powell's dovishness at the FOMC on 2/1. And then we broke the 21 for the first time in weeks, tested and held the 50-day today. We've got a plan either way for what happens, whether we're going to increase. This is actually a very low risk entry on the 50-day moving average versus today's low. We'll see what tomorrow brings. And with that, I'm going to wrap up Wednesday, February 22nd. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.